Canadians are increasingly relying on credit cards to make ends meet, and the amount of debt piling up among insolvent households spiked by almost 26% last year. Our guest says this latest report, quote, tells a troubling story. We're joined by Doug Hoyes, co-founder of Hoyes, Michalos Associates. Thanks very much for coming on the show.
Thanks, Andrew.
We often hear credit card debt called toxic debt because the interest rate is in Tony Soprano country, north of 20%, but people are turning to it.
Yeah, you're exactly. Good. Okay, we refinance our house because that's the lowest interest rate. As things get a little bit worse, okay, maybe I have to rely on a bank loan. We kind of move up the risk curve, as it were. Well, what we're seeing now is that people are getting tapped out on their mortgages. Now they're getting tapped out on their unsecured line of credit. What's the next thing you turn to? Well, it's credit cards. And what we saw with our clients, so this is the people who filed a consumer proposal or a bankruptcy with my firm, Hoyes Michalos, last year, their credit card debt has gone up by a massive amount, like you said, almost 26%. That is a huge indicator of what's to come, and obviously it's a very troubling statistic.
Because people need to be desperate to turn to credit cards?
Because, yes, maybe not desperate, but it is not your first option. If you want to borrow $5,000, you get a bank loan at 10% interest. You're not putting it on a credit card at 20% interest and not paying it. So we look at this as a glimpse of what's to come. A lot of people think, okay, well, you're talking about people who've filed an insolvency. That's not representative of the Canadian economy. And no, I would agree that that's true. But what it is a glimpse into the future of what's to come. If a certain segment of the population is getting into trouble now, as the economy continues to have problems that you continually report on, then this is probably what we're going to see more of as time goes on.
Overall, in the economy, do you have any kind of a handle? Are consumer insolvencies or proposals or bankruptcies increasing, Doug?
Yes, they absolutely are. They were up, depending on where you look in Canada or Ontario, Ontario was up 18% last year. Canada was up about 11%. Now, that's off a relatively low base because insolvencies plummeted during the years, 2020, 2021. Nobody was, courts were closed. People weren't getting garnished. People didn't need creditor protection. But that number has been increasing steadily. It was a big increase last year, and we expect that pace of increase will be even greater in 2025.
Among people who are filing or who are insolvent, they've seen a huge drop in their homeowner equity. Why would that be? I mean, house prices haven't collapsed. I mean, I know they're down from their highs.
And that's the key. They're down from their highs. So if you bought your house 20 years ago and you don't have a mortgage, you're not coming in to see me, you got tons of equity, everything's fine. But if you bought your house at the peak in, let's say, 2022, you had a 5% down payment, got a high ratio mortgage, and you perhaps got a variable rate mortgage, or you had a mortgage locked in at a very low rate. Now we're starting to see those mortgages come up for renewal, and there's a whole lot of them that come up for renewal in 2025 and 26. The people who've already had it come up for renewal now have much higher interest rates that they're paying. And those are the people who are going, maybe what I need to do is sell my house to get out. Well, if your house value is down 10% and you had a 5% down payment, you're underwater. And that's something, we're not seeing it with a massive number of people, but we didn't see any of that in 2022. There was nobody who was underwater on their mortgage. Now we're starting to see it. And that, again, is something that is going to continue to get worse as time goes on.
What is the cause of this increased stress on households? I mean, unemployment hasn't gone up that much. I know it is up.
That's part of it. You're right. But you're right. That's not a massive stress. I think one of the biggest ones is inflation. And again, people are going to say, well, inflation, you just reported it's down to lower levels. Yeah, but it was quite high. There was a period in 2022, 2023, we had like 6 months in a row where, food inflation was more than 10%. And so even though the inflation rate has come down, the costs have not come down. Inflation just means the costs are not going up as fast. So we're still paying those high prices. And of course, now the threat of tariffs and everything else is spooking people as well. The people we're seeing did not see their income go up as much as costs have gone up. They get squeezed. What do you do to bridge the gap? You turn to credit cards. That's what we're seeing.
Is there any sign of an improvement, or do you think we're on a downward trend here?
Well, I hate to say it, but I think we're on a downward trend. And again, if you own assets, if you own a house, if you got money in the stock market, your crypto's doing fine, everything's great. But it is the segment of the population that does not own assets who did not benefit from inflation. Their house price didn't go up because they're a renter. Those are the people who are getting squeezed the most. Their costs have gone up faster than their income. And I don't see that changing. I don't see a big spike in incomes. I don't see any kind of drop in prices coming up. And as mortgages, other debts come up for renewal at potentially higher interest rates, that puts yet another added stress on people. So if the unemployment rate does tick upwards, if tariffs do come in, then yes, I see a lot of trouble on the horizons for people who are carrying debt and don't have significant assets to back it up.
We were joined by Doug Hoyes. Thank you very much, Doug. And he's co-founder of Hoyes, Michalos Associates.